This is the Retirement Key Podcast with Abe Abish, founder of Abish Financial Services.
A lot of firms out there say they will do tax planning, say they will do Social Security planning and RMD planning, and typically they just do investment management. They want your money.
You've worked hard your whole life to earn and save. Now you need a plan to make that money work hard for you.
Where do you stand today with your retirement accounts, with your insurance, with Social Security, RMDs, taxes, all of it? This is how we need to think. We need to think outside of the box on these matters.
Abe is here to help you unlock the keys to your retirement.
There are things that we do in the throes of these cold winter months to get us through, whether it's just listening to the Beach Boys or doing like you do, actually taking the vacation to Jamaica. Welcome back.
Thank you. Welcome back to the snow and ice.
Right,
as I quickly found out. Went from 85 and sunny, like low to mid 80s and sunny, Heather, to 15 to 20 degrees with a good chunk of snow and a lot of ice still on the ground.
January and Nova, y'all.
Yeah. Now I truly understand the snowbird concept. Like, let's get the heck out of Dodge into a warm state for these 3 or 4 months, because there's no snow shoveling down in Florida and warmer states.
So you had a chance to vacation a little bit in Jamaica.
Yeah. Really, it was a investment kickoff conference, and we were actually asked to speak.
That's cool.
So one group that we work with works with several thousand financial advisors and retirement planners across the country, and we happen to be in that top part of that group, and we're asked to actually speak to about 100 of the country's top financial advisors. And so we did, and we happened to get that and a couple days of really good R&R. I'm telling you, it's great to reset at the beginning of the year and just have a clean slate and really start off fresh and strong and healthy. And so it was just a fantastic trip all around, and looking forward to having a great year here with our DC metro area community.
It is. It's so important, I think, to take some time to reevaluate, reset, and refocus. We were emailing you and I when you got back from this vacation. You were like, it was awesome, but I'm pumped. I'm ready to get back to work. And I was like, okay, let's go. Because there is plenty to do, of which I do not need to clarify or explain to you, I am sure.
Oh, yeah. Lots going on in the markets right now.
I mean, the headlines, they just won't stop from any kind of aspect, any kind of which way you'll look at it. And we are only just a few weeks into 2022, and so many of us are sitting here scratching our heads trying to figure out what's yet to come. It's so hard to read what the heck is going on with the economy. And then the stock market continues sharp ups and downs as it's reacting to inflation and talks about the likelihood of interest rate hikes by the Fed. Who knows how the next chapter of the pandemic is going to read? U.S. Bank chief economist Tendai Kapfidze, he was telling Yahoo Finance that it's a tough call.
The last 2 years have really taught all of us a lot of things can change and change very rapidly. And, you just have to look at, the Fed itself to see how rapidly things change and the way that the Fed speakers are now addressing the economy versus, just 3-4 months ago. So in 3-4 months, again, going forward, who knows where we could be. So, but there's a lot of risk and uncertainty to that outlook. And that's kind of what I'm trying to emphasize.
Okay, this guy is supposed to be a so-called expert. I was waiting for him to go, Abe, I'm sure you've been getting lots of calls from concerned clients amidst all this confusion. What is it that you are telling folks who are calling up worried?
This is what we've been talking about the last few years, Heather. This is largely in part due to the Federal Reserve starting to taper, starting to pull back from the cash injection that has happened over the last few years. It really started in 2008. Compare it to, maybe not the best analogy, Heather, but compare it to a drug addict. Like, let's say someone is just hooked on heroin and they're on it every day or multiple times a week. You start slowly pulling off that drug, or you stop completely, and there are severe withdrawals. Right? Same thing with this whole cash injection into the economy by the Federal Reserve. It's all started in 2008 when the Federal Reserve came in, lowered rates almost to zero, pumped trillions of dollars into the economy to rescue it. Okay, that works, but that's going to have ramifications down the road. We have continued to kick this can down the road. All of a sudden, we're waking up to high inflation. That just didn't happen overnight. Because again, in March of 2020, when COVID hit and started, same thing happened. The markets crashed, economy crashed, Fed comes in, lowers rates to zero, pumps in trillions of dollars of cash to rescue the economy. March of 2020, the worst month in market history. April of 2020, one of the best months in history. 2020, we come out with a 20% return. 2021, we come out with an almost 30% return. Everyone knew that this couldn't continue forever. And I'm not saying that the markets are going to crash this year, but for goodness sakes, how difficult is it to ride out a market just filled with cash over the last 10 years? We've all seen our portfolios and net worths and asset balances increase so significantly, and it's been nice, but it's easy to ride that wave, Heather, when the markets are going up. It's not so easy to ride that wave when we have turbulence and volatility. And we've been preaching on this show, and tons of experts have for years now.
Right.
We have to have a plan. We have to be proactive. This is not going to last forever. What happens if and when we have another tech bubble type of situation, or a 2008, or even a half of a 2008, which would be like a negative 20 or negative 25% in a year? For a lot of people, that would be devastating. A lot of people, that could cause them to have to go back to work. So we are getting a lot of calls right now from prospective clients. Hey, last year wasn't the right time. I saw my accounts go up 30%, but now I realize, the importance of working hand in hand, side by side with a professional who can help take emotions out of the equation and who can put together a retirement plan that's methodical, that's mathematical, that's not emotional, and that's proactive, where things and measures are in place. So we're getting a lot of these calls right now, and rightfully so, Heather. We had a gentleman call in recently who was in the same position, concerned with what's going on in the markets and in the world in general, has done a fantastic job of saving and accumulating for a retirement, Heather. This is almost always the case when someone calls in from WMAL. This gentleman and his wife have $3 million saved.
Awesome.
They're in their early 60s.
Yep.
They live in the Manassas, Virginia area. Retired federal government employees with TSPs, some IRAs, real estate, etc. Fantastic job. However, they are predominantly just using the TSP for, their retirement plan, for how they invest. And in any 401k, TSP, or IRA, you're going to have limitations.
Right.
And the TSP, like anything, is not perfect. It has pros and cons. Well, what they've really been trying to do is kind of time the market and go in and out of the G and F funds in the TSP, which are the quote unquote safer funds in the TSP, to try to time the market. So when the market takes its dips, they're going to cash, then they're going back to stocks and equities when the markets are up.
Jeez, that sounds so stressful.
Oh my God. Can you imagine?
No.
That's the last thing that I would want to be doing if I was 63 with $3 million. I'd be like, babe, where's our next trip?
Right?
Okay. Yeah. How did we do last year in terms of return? How much money do we have coming in this month? But for goodness sakes, trying to manage it on your own and trying to time the market and reading, Kiplinger and Kramer and Forbes and Fidelity and getting advice from every single outlet out there can be confusing. And to try to do it on your own, I'll tell you what, we see a lot of successful do-it-yourself investors, but there's a major difference between pedal to the metal, getting up that retirement mountain, and then descending down the retirement mountain safely into retirement. 80% of mountain climb accidents, Heather, happen on the descent, happen coming down the mountain into retirement. And so it's easy when the markets are up for 10 years in a row. Not so easy when we have choppiness, turbulence, and volatility. So what were some of the solutions? Well, we found out that obviously this couple's going in and out of the G fund, and they're using dead money and instruments that may have worked in the past to provide protection with upside potential. We replaced that dead money in their portfolio with instruments that can provide principal protection with better upside potential than perhaps the GNF funds and government and corporate bonds. And ultimately what we did, Heather, that really helped them out is we gave them a TSP and IRA analysis and portfolio X-ray. What does this analysis provide? It shows you what your potential returns would be if you made no change. It also shows you what are your fees and expenses. People don't realize, we do these analyses all the time, some funds are very cheap, some funds are very expensive. And that eats into your return if you have an expensive, costly fund. What is your risk? What is your risk measure? How much risk are you taking in order to get that reward? Is the risk you're taking too much? Is it too high? Should we consider reducing that at the point of retirement? Further, if we had another 2008, what would your portfolio lose if we had another 2008? All that analysis, all of those numbers, all of that data is offered in our complimentary TSP 401k and IRA analysis. So if this sounds like you and you're worried about these similar types of situations as we just described, go to retirementkeyradio.com, click on the Contact Us page, and we'll start the conversation with you about the planning process and how we might be able to help you out.
Let's continue this conversation, the idea about our market investments, Abe, because that was more of a this time right now specific, but I wanted to ask you about the idea of the overall rebalancing process, which is, of course, looking at your portfolio's assets and determining if the allocations have perhaps drifted away from your financial goals. Morningstar's Amy Arnott says it's especially important for older investors, this rebalancing process.
So if you're approaching retirement age or already in retirement, you probably want to keep a pretty close eye on your portfolio allocations and make sure they haven't drifted too far away from the target levels that you have in mind. And the reason behind that is what we've called sequence of returns risk, which is the risk that your portfolio goes down right before you need to start tapping into it for retirement income.
This also relates back to this original conversation we were having a few minutes ago, Abe, the idea of how daunting this kind of task can be going at it alone. But this is something that's in your wheelhouse, right? How often should somebody re-examine their asset allocations?
Probably several times a year at least, Heather. And so the solution for us is providing quarterly reviews, because things can only get out of whack so much if we're having meetings with our clients 4 times a year. We are watching the portfolios and the plans often. Now, things can obviously be changed in between every 90 days, but that's staying on top of it for the most part. Instead of just sticking to a model, like a lot of big box firms, Heather, will stick to this model. Let's say it's a 60-40 portfolio, 60% stocks, 40% bonds, which used to work out really well in the past. A lot of firms are still sticking to that cookie cutter model, and they'll tell their clients, hey, Mr. and Mrs. Jones, we recommend you holding to this model for the next 7 to 10 years, which is an economic cycle typically. And so the issue is that when the markets are doing really well, let's say the stock market's doing really well, which it has, we could see that 60-40 portfolio go out of whack and maybe go up to 70-30 or 80-20. And what those firms will do is they'll sell their winners, come back down to 60 and buy the losers and bring that back up to 60-40, right? Because we don't want to have too much of a position. We don't want the positions to get out of whack if we're truly trying to hold a 60-40 portfolio.
Okay.
That is called rebalancing. And so that is very important. We do that 4 times a year. We use technology. We don't hold to those cookie cutter models. One of the biggest reasons why is because bonds right now stink. And for the next 3 to 5 years, bonds will probably continue to stink because yields and interest rates are so low. Further, we all know bonds and interest rates have an inverse seesaw relationship. And as interest rates start to rise a couple times this year, which they should, we will likely see bond values go down. We're in a huge pickle and a huge dilemma. We don't follow those old school cookie cutter models. Instead, we use technology. Who are the best players we can get on the field right now? How do we determine that? Through algorithms, through artificial intelligence and technology. De-risking the portfolio right before retirement. Avoiding large losses right before retirement, right into retirement, is perhaps the number one thing a pre-retiree and retiree can do. If you are concerned with what the markets are doing right now, if you feel like you saved enough, you're darn close, you're ready to punch out the ticket this year and retire or soon, and you're concerned with what's going on, you need a plan, you want a compass check, you want what you have analyzed, we'll provide a complimentary comprehensive investment and risk analysis. Sometimes we call it a compass check. Where do you stand? This gives you all the details, strengths and weaknesses of your current portfolio so you can see where you stand today and if you need to make any changes right now. If this is something you want to learn more about, just visit us at retirementkeyradio.com and click on the Contact Us tab there.
Thanks for listening to the Retirement Key Podcast with Abe Abish. To learn more about Abish Financial Services, visit retirementkeyradio.com. And join Abe for his radio show, The Retirement Key, Saturdays at 2 p.m. on WMAL.
Patrick Volk is an investment advisor representative of J. Hagan Capital, Inc., a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Abraham Abish and Patrick Volk are licensed in your state, please call 571-577-9968. Abish Financial Services is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Abraham Abish or Patrick Volk. NPN number 770-3575 and NPN number 727-978.